Good morning, welcome to ANZ News. It's Thursday, 3rd of September, almost the end of the week. If you've been enjoying our YouTube channel, remember you can always just make comments. If you love it, hate it, if you've got anything interesting to add to any of our articles, feel free to comment through our YouTube channel. Today we're talking US stocks have COVID and our immunity is in a recession. Yesterday, you will have seen the news of Australia plunging to its worst GDP fall on record and officially entering its first recession in 29 years. Nothing speaks to the insanity of markets more than the fact that Aussie shares rallied solidly, and not because it was better than expected, it was worse than expected. Overnight, the US share market hit a historic milestone, and the two aren't divorced. But first, if you somehow missed the local news, here it is in a snapshot. GDP for the quarter fell 7% after the 0.3% contraction last quarter, and 100 points worse than the 6% expected. Year-on-year GDP plunged 6.3% compared to the 5.1% expected. Household spending, which accounts for about 50% or 56% of our economy, slumped 12.1%, subtracting 6.7% points from GDP. Government spending rose 2.9%, adding 0.6%. Social assistance benefits rose 41.6%. Investment in new and used dwellings fell 7.3% in the quarter. Net exports contributed 1% to GDP. The savings rate soared to 19.8%, the highest since 1974. So people are starting to put their money away. Graphically, you can see how it compares to previous recessions since the 70s. This next chart here is showing recessions in Australia and their history. Just take a moment and make some comparison between the 1974 to 75 recession, 82 to 83 recession in red, 90 to 91 recession, and now 2020's recession in blue, all that light blue there. In stark contrast there, this recession looks extremely bad. The question at large is where to from here, and that is the crystal ball stuff. Victoria is 25% of the nation's economy, and it is struggling in lockdown, whilst other states are seeing a bounce back in growth, albeit anecdotal at this stage and not likely enough. At large too is the effects of border closures and tourism, put at a $33 billion impact yesterday as the clean premiers ignored the PM's calls to open up their borders and save the economy. None of them look like budging. The other elephant openly in the room is the property market, and how will it fare after the reality of removing government income support, pilfering of superannuation, and mortgage holidays ends next year. Already without these realities, the damage is being done with the sharpest declines since the 1980s. This next chart we show here is the 5-city peak to trough declines. A little bit tricky to understand, but this one shows the different periods of attention around 82, 83, 89, 91, 94, 95, 2004, 2008, 2010, 15, 2017 and 2020. This is anticipating the peak to trough decline in months. So you can see how far that trough declines as well as the extent of period. And again, with the aforementioned emergency relief measures, we are already seeing stresses in the property market that forbear bad things ahead. Banks are tightening with credit falling. Mortgage stress has risen to 40%, or 1.52 million households. Rental stress is at 41.1%, or 1.78 million households. And property investor stress is at 25.4%, or 826,000 properties/property investors. They say property prices only fall when people have to sell, and those stress numbers during recession don't bode well. Adding to concern is a survey by comparison giant Finder of Australian financial experts and economists. And they said, when asked when Aussies could expect banks to make the move, half of the respondents said banks were likely to announce out-of-cycle rate hikes during the first half of 2021. Banking profits have nosedived off the back of billions of dollars worth of loan deferrals, a shrinking pool of first-time buyers, low interest rates and minimal credit growth, said Finder Insights Manager Graham Cook. This may send banks scrambling to recoup lost funds by pushing up loan rates to absorb some of these costs, which will come at a detriment to mortgage customers. One would have to question any action that would see or increase defaults when you are at the bank, but this is a survey of experts, so it needs to be heeded. The old saying, owe the bank 1,000 and it's your problem. Owe the bank $1 million and it's their problem comes to mind. That said, you wouldn't want to be an Aussie bank right now. Ipso facto, you may be nervous as an unsecured creditor of a bank too, or i.e. a depositor. There are still plenty coming to our store getting money out of banks and into gold for that very reason. As we started, against all of this, Aussie shares rallied yesterday. If one really wants to look at the blow-off, look at shares right now, late last night in the US, and it must be instructive. Last night we saw the largest share market index in the world, measured against forward price earnings multiples, break the all-time high set by the dot-com bubble. Somehow we're in a bubble right now. The S&P 500 chart's just shown here for forward PE multiple and S&P 500 resistance points, all at liquidity levels we haven't seen since the GFC. There's a lot of liquidity in those markets right now as the Fed continues to pump a lot into it. This next chart here showing market liquidity. This last chart is incredibly important for a number of reasons. Never before have we seen market breadth so incredibly narrow. The entire S&P 500 is so completely dominated by just 5 shares. The so-called FAAMG or FAM tech stocks now accounting for nearly 25% of the entire index. That without them, the other 495 companies are all down around 5% for the year. This next chart here showing the 5 largest stocks and their return. Facebook, Amazon, Apple, Microsoft, and Google. But it is the concentration of just 5 shares when things turn that makes the market liquidity so very scary. However, the other potentially larger issue at play is the emergence of these massive passive funds and ETFs that, at the name suggests, don't analyze, they actually just follow. When all that money races for the exits at once, and compounded by it being largely in just 5 shares, you can well imagine the precipitous spiral that it would cause. This next chart here showing active equity versus passive equity, and that huge growth that we've seen since around, I'd say 2012, 2014, and its exponential increase every single year from there. We've all heard the saying, if America sneezes, Australia catches a cold. This isn't a cold. Taking the analogy to 2020, America is showing all the signs of COVID-19, and we are inextricably bedfellows with an already very poor immune system. So wishing us luck in Australia. Remember, you can always hedge your bets with a bit of gold and silver. So that's news for today. You can go to ainsleyBullion.com.au to see all of our gold and silver products and purchase online. Ainsley Wealth for our cryptocurrency products, also for buying online. And our gold and silver backed cryptocurrency token, which is goldsilverstandard.com. Make sure you leave all your comments, likes, loves, everything here in our YouTube channel. It's end of week tomorrow, so we'll catch you for some more news then.